Ontario Teachers' Pension Plan is one of the world's largest and most influential institutional investors, managing nearly $200 billion in assets globally. Their investments in India stand at over $4 billion and are growing, with a diversified portfolio that spans infrastructure, private equity, real estate and tech. Ontario Teachers is known for its long-term patient capital and disciplined investment approach. Today, I have the pleasure of sitting down with Ontario Teachers' CEO, Joe Taylor. Joe, welcome to the program. Thank you very much.
Thank you for having me.
For markets globally, it has been a time of change, some confusion, but lots of opportunities ahead as well. So with that short preamble, let me dive straight in. Joe, once again, how are you liking your Mumbai trip so far?
It's always nice to come here. I find the optimism in India really encouraging. And there's good reason to be optimistic. Lots of good things happening in the country.
Although right now, a lot of the focus is on what's coming next week, 2nd April. Trump tariffs, reciprocal tariffs day, or as President Trump has been calling it, Liberation Day for the U.S. I mean, as a patient, long-term investor, Joe, how are you thinking about this? Do you think, I mean, do you go with the this too shall pass attitude, or you think it'll do some durable damage?
We're probably a bit in the middle. So we are a very long-term investor. You know, our liabilities go out 40, 50 years. So
Right.
The first thing you want to do is not overcompensate. And some of the impacts of the tariffs isn't really fully understood yet. Second thing to say is we try to plan to have a very diversified portfolio, both in terms of the asset classes we hold and actually where we hold it around the world. So really what we're trying to do always is to be agile, but also to be thoughtful about what we might want to bring in as new investment activity and where we probably feel a little bit more exposed. But coming back to the US, we probably have around 30 billion of investment there. So it's a material market for us, and it's also been a very profitable market for us over 20, 30 years.
You said I don't want to overcompensate, but is there a risk of underpricing the risk?
Well, our job's not to do that. You know, we do take risk and we're willing to do it. We're a mature plan, so we have to be careful. Our contributions out exceed our payments in every year. But what I think I would say is that you can overreact sometimes to news flow and things that look like they could be a material impact on your activities without really fully thinking through how it's going to land. I think we're honestly still in that mode of still trying to evaluate what to do. But certainly, if you're based in Canada at the moment, there's a lot of reflection. We've got an election coming up. We've also got quite a few initiatives that have been developed about how we continue to invest in Canada ourselves, but also how do we help trade where it may be going less into the US than it did before.
You know, you sit on top of one of the largest sort of institutional investing assets globally. My question is, which way are you leaning? Do you think this will be a bit of a break from the past, what is being proposed, you know, America first, tariffs, and it looks like they really believe in it. It's not like a negotiating tool and then you sort of propose something and walk back all of it. We will find out. But without going into specifics, do you think it's, on many fronts, not just from a market standpoint, it's a bit of a break from what we've had so far for a few decades, actually?
It does feel something different. We're actually trying to plan for something that is enduring, because that's the easiest way to be sure of probably the one with the biggest implications for an investor like ourselves. The thing I would stress is, and you did it in your introduction, so thank you for doing it, is, you know, we are an international investor.
Yeah.
We do look to try and have a diversified portfolio around the world. That's why I'm here in India. That's why we have a team on the ground here. And sort of my job is really to say if it gets a little bit more tricky in some markets or some asset categories, what do we do? And that agility and that willingness to innovate and try some other things out has really stood teachers out for a little while.
The other, I mean, you know, so for example, America first.
Yes.
Making in the US has been a big sort of theme. We got this 25% auto tariffs on cars not made in the US, right? I mean, that's just one example. What about capital itself? Will capital allocation strategies change because of what is happening? You know, US versus the rest of the world. I mean, actually, in many ways, US has been the only game in town for the last few years. Will that continue to be the game in town, or you think, I mean, how are you thinking about the whole thing?
Sure. Well, it is an attractive market. If you look around the world and you look at the risk-adjusted return, America has a lot of positive things going for it. That probably means we'll try to continue to see other ways of having exposure to the US. And probably if we're not able to do that, maybe because of sort of more of an American first mentality, we'll then have to really try and work out other destinations for some of our capital. I think you also think about two other things which are very important to us. So one is, it's not the new deployment of capital, it's what you already own down there, which actually how do you make the most of those businesses in terms of maximizing their value. And secondly, we're very, very keen ourselves as an organization to invest in companies not only to get a return for our members, but to get do it the right way so we improve those businesses as we own them. So to be a good custodian of the asset, making sure it's a better business when we sell it. Now, if that's not possible because we have a different outlook to some of the American states, then that might be problematic for us.
And are we going in that direction, to your mind?
It depends what we're investing in. So I would guess if we would say we're investing in something around healthcare, that might be a little bit more controversial than trying to help on electricity, power and transmission, which I don't think is that controversial, but there is clearly a need in the US for more power to serve the growth in demand from data centers and other activities.
What about sort of regions like Asia, India in particular, China, for example? I mean, with this America First stance, what does a money manager do as a global investor? I mean, if you're in one country, if you're an Indian investor, and mostly you can only put your sort of money in India or in the US for that matter, it's different. But you have money everywhere. How does this change things for you, especially with regards to Asia and India?
Sure. Well, we've been investing in Asia for a while. It was a deliberate decision to actually give us that access to higher growth, interesting markets where there's a lot going on in technology and sort of new areas as well as some of the more traditional fields. We've paused our investing activity in China. We did that a couple of years ago. We actually made that choice because we felt we couldn't necessarily see the growth in that market in the way we had seen hitherto. And also, from our point of view, we trying to compare what we could see as a new investment opportunity there with other parts of the Asian region even. I think it's very dangerous to see India as a substitution for China. It isn't. It's a different business. It's a different market. There are different businesses here. But what we do see here, I think, is a country which is, let's say, disappointed with 6% growth. I mean, I'd be delighted with that in Canada at the moment, to be quite honest. But it also has a very supportive government for inward capital like ours. It has a stable and growing economy. It has the right currency in terms of it being stable to the Canadian dollar, which is one of our other considerations. And we've made co-investments with the Indian government in things like the National Infrastructure Fund, where it's allowed us to navigate what's actually coming up as investment opportunities in the near future. So we've invested in a number of toll roads as well as hospitals and other growing sort of tech businesses in the region, and they seem to be performing very well.
Just one last point with regards to tariff, and then we'll move on to what you're doing in India and where you see opportunities. The common refrain is that tariffs are bad, and it's going to be bad for trade, bad for markets, etc. But 2 points. One, if everyone lowers tariffs, it is good for trade, I mean, globally. If reciprocal tariffs result in lower tariffs for everyone, everywhere, that is one. And second, some of these policies which the US is pursuing under this new administration seems to be firing up, we got to do it for ourselves kind of a sentiment as well. I mean, what you're seeing, what's happening in Europe, for example, Germany, countries wanting to invest, spend more, break out of the sort of, fiscal limits, etc. Canada, I think you briefly spoke about, there's increased sort of, people are rallying around doing more for Canada, in Canada. And I mean, I think those things are happening in Asia as well. In places like China, etc. Do you think, I mean, there is one, it could move in this direction the way I'm sort of describing, or you think it's maybe convoluted and it is bad, it's all bad? What's your sense?
I think the bad thing about the current discussions from trade and tariff perspective is just the uncertainty. When you're not sure exactly where you're going to end up, it's quite hard for a lot of businesses we would potentially invest in to know how they're going to grow and deliver that return for us as a long-term investor. The second thing I'd say is around the tariff scenario is, as you rightly point out, it can increase that tit-for-tat type of nationalistic sentiment in terms of reacting to what could be, as you say, perfectly balanced trade discussion. It's probably better, in my opinion, to be framed through a trade discussion than actually, an arbitrary number that is actually being debated. But from our point of view, honestly, I go back to my earlier point. We try to stay reasonably apolitical. We would like to be able to find businesses that can plan for the future and not be particularly impacted through tariffs being implemented on them. And, I think the businesses that are probably finding it most difficult at the moment are manufacturing companies, particularly where they have subcomponent parts passing cross-border, where it's then quite difficult to know what exactly is not only the end tariff cost, but how you document for it.
Got that. Joe, what we're going to do is take a quick commercial break here, come right back, and we continue our conversation and focus on what you are doing in markets like India, what you like, and which of the sectors you find opportunity in. Stay right here. We're going to take a break. See you on the other side.